Dear clients, I'm Richard, Senior Philips CFD dealer. Last week, major US equity benchmarks ended on a mixed note, although all were idling at or near record highs. Both the tech-heavy Nasdaq 100 as well as small-cap Russell 2000 posted week-on-week gains, with the Russell 2000 outperforming year-to-date relative to its larger peers. On the other hand, the S&P 500 and the Dow Jones Industrial Average 30 slipped back during midweek to end the week slightly negative. Last week, economic releases were mixed bag too, and it also seems to have taken a back seat in terms of driving market sentiment. On Friday, the US Department of Commerce announced that the economy has grown a little less than first estimated in 4Q14, even as consumer spending increased at its fastest pace in nearly 4 years. The revising down of the GDP reading to 2.2% from a prior estimate of 2.6% was mainly attributed to a smaller gain in stockpiles and widening trade gap. On the US policy front, one of the most anticipated events was the two-day semi-annual congressional testimony on February 24th and 25th by the Fed. The key takeaway was a dovish-sounding, data-watching Fed, offering assurance of a continued low-interest rate environment for now. Most investors interpreted Fed Chair Janet Yellen's comments as the Fed should not be in a rush to raise rates, notwithstanding any slight twists to the coming post-Fed meeting statements, such as removal of the patient language in normalizing monetary policy. Indeed, the global wave of central bank policy easing from US and China to Europe and Japan appeared to calm equity markets, as exhibited by VIX, also known as the Equity Fear Index, which tumbled 36% in February, closing in on the 13 handle, after it surged as much as 17% in January. In other cross-market actions, it is also hinted that Yellen's testimony has helped to alleviate some investor concern that the central bank will start to raise interest rates sooner than expected. This is reflected by the rally in the benchmark 10-year Treasury note that brought yield back below 2% early in the week. It is also noteworthy to highlight that, contrary to many investors who believe that the June initial rate hike is most likely, the higher current impact probability is, as indicated by the Fed Fund Rate Futures, is a likely rate hike in September, 35.1% versus 16.4% in June, according to CME Group FedWatch. Looking ahead, this week's events calendar are filled with major central bank rate decision meetings from east to west of the globe, starting with RBA on Tuesday, followed closely by BOC, BOE, and ECB, among others. Hence, investors will receive an update of the global outlook and policy directions for a better assessment of potential market implications. Furthermore, in the US, February's labor market data on this Friday may take on greater significance, given that it is a major data point ahead of the March 17th to 18th Fed rate decision meeting. Clients may consider using Philips CFD to trade equities and indexes across markets to capitalize on trading opportunities in both rising and falling markets. In addition, you may also trade based on different strategies using many more benchmarks, which are available with Philips ETF. Thank you for watching this week's Market Watch. I'm Richard from Philips CFD. Tune in next week for more Market Watch videos.